Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods, and today we're talking about covered calls and what to do if they're in the money and there's a dividend coming out. Now, I was lucky enough to get an email from my brokerage. Interactive Brokers sends out an email every time there's a dividend being paid out, and if I have positions where there's a potential that my shares could get called away from me. Today we're talking about the age-old question. I have covered calls in play, there's a dividend being paid out. Is the other party going to take my shares away from me and so I don't get the dividend? That would be not very nice because I own my shares and I want to keep them. So I want to know whether or not these shares are going to get called away from me and if there's something I can do about it so that I can continue to hold my shares, continue to collect my dividend. Now, as always, I'm not a professional investor. I don't work in the finance industry. Instead, I'm just a YouTuber that loves investing, and I make videos so that you guys can make more money, I can make more money, and if you're into that kind of thing, you should join me in the chat room. I should show you this cool setup I've got. Like, look at this. I got my chat room right there. You know, multiple screens. That's mostly for my chat room. For this basic style of trading that we're doing today, we're talking about Apple covered calls. Now, if you've been following along on my Patreon, all of these trade alerts are actually posted publicly, and they are a strategy called the wheel strategy where I'm buying stock and selling calls against it. Now, this year has been incredible. Apple has been on an absolute rampage, and it's been going up and up and up, and everybody's been making tons of money, and I've been kind of limping this trade along, which has not been a fantastic trade, but at the same time, it's still making more than 10% annually, which is amazing. I mean, that's really what we want to do, is have a high percentage return over and over and over again. So today I want to dive into this because Apple's going to be paying out a dividend, and I want to know if the shares that I already own are going to get called away from me because the short calls that I've sold against them are in the money. Let's take a look. So the first thing we're going to look at is this great email that I got from Interactive Brokers. Now, if your brokerage doesn't send you out emails, you should probably consider getting a brokerage that does, because this is very important. If you are trading and there's some activity happening in your account, it's really good to know about it. So Interactive Brokers is great. It's what I use. It's really the only low-cost brokerage that's available to Canadians. So they send out these amazing emails. I have a couple different positions, but the one that we're talking about today is this Apple short call right here that is November 11th, and it's the 141 call. Now, what it's telling me is that the projected dividend is 22 cents, and that's really going to be the determining factor, whether or not it makes sense for somebody to call the shares away from me so that they can collect the 22 cents dividend instead of me collecting it. So let's take a look at where Apple's trading right now. So 151 is where Apple's trading, and I have this call that is the 141 that we're talking about. So as you can see, the stock has been trading above 141 for quite some time, and I have agreed to sell my shares for 141. Now, why would I have agreed to that? Well, of course, I bought these shares down here. So my cost basis is around 130. So if I sell them for 141, I'm making a substantial gain, and I continue to make that gain anytime that Apple is above this line, this 141 line. Now, the question really becomes, it's up to me when I want to sell those shares. Let's take a look at the actual positions. So now for my patron members, they get to see all of my positions. I've got 76 active trades right now. And the one that we're going to be focusing on is this Apple custom trade right here, which is a wheel strategy. So what I have is I have 300 long shares. I've sold 3 covered calls against those shares, and I also have a short put. Now the short put's an agreement to buy more shares if it's trading under 141, and the short calls are simply an agreement to sell these 300 shares for $141. Now, why would I do that? Again, it would happen if the stock was trading above 141. And in this case, the stock's trading at 151. So in all likelihood, there's a good chance that these shares could get called away from me. So let's take a look at the actual contract that I have, November 19th. And it's the 141 calls. So this is what I own right here. Now, there's a really easy way to find out what the extrinsic value is. Now, that's the amount of money that it would cost somebody, or they would be giving up if they exercised their right and took my shares. All you have to do is look over at the value of the put, the corresponding put. So I own, or I am a short the 141 call. We look at the value of the 141 put, and it shows that there's 30 cents. Now, there's another way that we can do that. We can look at our brokerage platform, which shows this nice little yellow dividend. When you click on that, here it is, Apple November 19th, 141 call, -3. It's in the money by $10.25. And it tells me right there, 22 cents. No assignment is likely on dividend. And the reason for that is because someone would actually be giving up 30 cents in order to call the shares away from me, and then therefore they would be out $8 difference. So if that's me and I'm trying to make a little bit of money on this, I am certainly not going to call someone's shares away from me if I own a long call. Instead, I would prefer to just buy the stocks outright and sell my call, and I would make that extra $8. So this is a very, very safe position to be in. I don't have to worry about it. It is pretty close, but still 8 cents is enough of a buffer that it is very unlikely that my shares are going to get called away from me. But there's also something that I should be looking at, which is really there's only this little amount of extrinsic value. So the email was a good reminder to me to say, hey, why don't you take a look at this? You're getting the dividend anyways. Maybe this is a good time to roll these positions out in time and get a little bit more extrinsic value, which is really what we're doing when we're making these positions or playing these positions. We're collecting extrinsic value. So on this Apple one, because it's quite in the money, $10, I'm going to have to roll out a bit in time. So let me load up what I would have to buy back. And I currently have 3 of these 141 calls. I'm going to type 3 right there in the strategy builder. And I also have the 141 put. Now I typically just roll all of these together. It just makes it easier if I'm doing everything all at once. So if I go forward, covered calls, I like to play fairly short duration. So on a short duration, 36 days is pretty short. So let's just take a look. I'm going to be paying $10.40 to buy back each of the 141 calls. And if I sold another 141 call, it would be, I would generate a credit of about $11. So I would be making about $50 or so in cash into my account by agreeing to just delay selling my shares at a later date on December 10th rather than November 19th. But there's an opportunity here to kind of utilize the options together so that I can still get cash and I can actually roll these up to a higher strike. So let's take a look at what that looks like. If I agree to buy shares at 142, which is a very reasonable agreement, I mean, it's an 18 delta. And if we look at the stock chart, I would be agreeing to buy shares if the stock was down here at 142, which I think at this point in time is quite reasonable. I can agree to change my price on the put from 141 to 142. So that's what I'm going to do here is I'm going to sell a 142 put. Now that generates a little bit of money. You can see I'm only paying 30 cents to close the 141 and then I'm collecting $1.10 approximately. So about 70 cents of extra credit. Now what I can do then is then I can use that credit to sell these higher strikes of the 142. I can use the calls and puts together. And so what I'll do is I'll just change that to a 3. So I'll be buying to close my 2 positions, my 3 November 19th 141 calls, and I'll be buying to close my November 19th 141 put. Then I'll be selling a December 10th 142 put, and I'll be selling the 3 of the December 10th 142 calls. For this, I am actually going to collect money. So I'm agreeing to sell my shares at a higher price. So that would be an extra $300 in my pocket on December 10th. If the stock stays up, and today I get cash flow. So this is a way for me to take cash, which I can then spend. I can buy more stocks or do whatever I like with it. And I can actually raise my potential profit on this overall trade by a little bit. And all I'm doing is agreeing to buy stocks for $100 more, this put increase. So I think I'm going to go ahead and do that. And I'm going to see how much credit I can get. So it's showing the mid price at 128. I usually like to start a few pennies above. So let's do that. And then we'll go over here and hit submit, which I know is hidden by my face. We just confirm everything here. We confirm that we're buying November 19th 141 put, November 19th 141 call. And then we are selling the December 142 put and selling 3 of the 142 calls, which are covered because I have long stocks. Now I can update the price here and I can just change this to whatever I want. 127, we'll go update. It's not filling. And I just want to fill this for you guys because, you know, the part of this trade is that I'm showing everyone how this works. I'm just going to update this. The spreads are actually pretty wide in here.
Filled.
And there we go, it's filled. So it filled for 24 cents. And that's as easy as that is. So now I can go into my spreadsheet and I can record this 24 cents as a credit, and that will add to the overall credit that I've collected over the year. And you guys can see all of that. If you just head over to my Patreon page, you can see all of the transactions and where I'm at on this trade, which I'm trading with my real money. And of course, this isn't, you know, this is just an example. This is like what I'm doing. So you can see how I would do it if I was doing it with real money, which I'm doing, which is pretty awesome. Anyways, I hope that this has been informative, and I hope that that gives you some sort of indication. Oh, there's one more thing I should show you actually. Let's, now that I own those, now let's look, you know, here's the call. Here I own the 142 and it's still paying that 22-cent dividend. But now there's $100, over $100 in extrinsic value. So now it is absolutely cemented in my mind that these shares will not get called away from me. There is no way that anyone is going to pay $100 to collect the 22-cent dividend. And that is really what's important, is what is the extrinsic value of the call that I am trading? And the reason I look at the put side is because I would have to do some math. I would actually have to say, okay, the 142 is, you know, almost $10 in the money, and then the remaining is this dollar. So it's simple math, but I would prefer not to do it. So the cheat is just look at the put side. And there you go. You can see an approximate valuation. And that's as simple as that is. Now, if you're thinking, wow, that was way too complicated, then that is when you should be watching some more of my videos and seeing some of the basic principles of this. And if you walk through the step-by-step on Patreon, you can see exactly what I'm doing and why I'm doing it. Thanks so much for watching, and let's get rich together. See you very soon.